Howdy, Team 42. It's your skipper here, Darius Dell, to present our Around the Horn Weekly for Saturday, August 28th, 2021. As always, we've got a ton of content to get through, so let's just hop right in. Starting with slide 3, our key takeaways. Number 1, deflation remains the dominant market regime, with 18 confirming asset market VAMS contributing to its 37% market regime probability. We continue to believe deflation's status as the dominant market regime will be short-lived, however, and replaced by Goldilocks in short order. At 67%, our cross-asset correction risk indicator is simply too elevated to suggest positioning across the buy side is leaning long enough to cause big problems for asset markets in the context of static to improving policy dynamics over the next couple of months. Translating those views to the calendar, our risk management, our medium-term risk management outlook can be summarized via 3 short bullets. Number 1, we expect Goldilocks market action to dominate from a daily frequency perspective through early to mid-October, which implies broadening upside participation among cyclical sectors and style factors. Number 2, mid-October through mid-November represents a transition window for markets, and although risk assets may continue to grind higher in price terms, we anticipate a return to the unquestioned dominance of defensive sectors and style factors observed in the mid-June through mid-August period. Again, starting probably sometime between mid-October and mid-November. And then from mid-November onward, we anticipate the onset of a meaningful bout of cross-asset volatility associated with the realized, read not prospective, reduction in net liquidity provision out of the Fed and Treasury. So let me summarize that in layman's terms. The next couple of months should see an acceleration in net liquidity, particularly as the Treasury continues to draw down its cash balance, as Secretary Yellen continues to try to avoid breaching the debt ceiling. So that obviously is a net positive for risk assets. Ultimately, however, once we get to the other side of the debt ceiling, and of course it could be pretty messy from a headline risk perspective, but once we get to the other side of the debt ceiling, the real risk is not the debt ceiling itself; it's the how much Treasury supply we're going to start to see, most likely in November, certainly by December. That we'll see that'll actually really start to move the net liquidity dynamics really meaningfully in a different direction. So we ultimately expect that to be quite painful for risk assets. But until now, we have to see a lot of eyeball premium burn off. We have to see some crowded positioning reemerge across the CTAs and the quants and the pod shops and things of that nature, and the macro funds. A lot of folks just haven't been fully invested. And I think they got their signal on Friday in terms of I wouldn't say necessarily dovish tilt out of Jackson Hole, but it really was just in line with our expectation, which is it's been since we got the confirmation from Powell in the July FOMC meeting. It's like, look, man, this taper's not going to come until November, December, the actual taper. Now they're going to talk about tapering literally every single day between now and then, but the reality is they're still going to be buying $120 billion of paper a month until then. And so that to me is the real key takeaway. You got to see the forest, not the trees. And unfortunately, for a lot of investors who've had a really tough time trying to perform in the second half of 2021, 1, they should have watched my Real Vision video with Ed Harrison in early June. 2, a lot of folks had a tough time trying to perform because they were staring at the tree bark that is, kind of high inflation, or the tree bark that is the tapering discussion. And they're not realizing that, hey, growth is inflecting lower, but it's not crashing. Inflation's inflecting lower. And it's going to stay high and sticky, even though it's disinflation. And both of those things have carefully back-tested conclusions for asset markets, which we understand as well as anybody. And ultimately, the reality is, as long as the policy setting doesn't actually change, you can stay long. You can get back in there. The first part of that discussion was stay long, be defensive though, and the second part of the discussion is actually start to become more offensive. And ultimately, we still think there's going to be a lot of market risk, particularly for risk assets heading in, the really, mid to late Q4. But again, as I mentioned, it's August 28th. So, to get back to the key takeaways, if the evolution of the data causes us to change our mind on any of that, we'll shout it from the rooftops. I'll be very loud about it. I'll write about it every day. I'll tweet about it. I'll get on these videos and say sell stuff and raise cash and things of that nature. And we built a very robust process, a very proprietary, robust process that allows us to sort of have a lot of checks on that. Obviously, CACRI is one of them. The actual market regime nowcasting process is the most obvious one. But in terms of getting the secondary checks, it's detailed in our recent reports. We have 3 signals that'll call us to meaningfully pull forward the market implications of kind of, this expectation that we're going to see a pretty meaningful risk off period, sometime in mid to late Q4. And number one on that is a bullish VAMS breakout in the dollar index, the Bloomberg dollar index, which is a much more thoughtful basket, much more carefully constructed basket of the DXY. And then number two, a bullish VAMS breakout in high yield OAS. Although, by the way, for those of you who are new with us, VAMS is short for volatility adjusted momentum signal. So if we see a bullish VAMS breakout in the dollar, bullish VAMS breakout in high yield OAS, and then a bearish VAMS breakdown in the VVIX ratio, if we see all three of those things, to me, that's a signal. That's a clean cut trifecta of signals that market risk is meaningfully accelerating. And if we don't see all three of those signals, then we're talking about episodic and non-trending bouts of volatility that are very risk manageable, that are very, you can trade around them. You can obviously accumulate positions when you see them. And there's a lot of things that are, nearing overbought, particularly as I tried to add a lot of stuff this week, but, everything was overbought. So we didn't want to be cavalier about this sanguine view for asset markets in the context of that. But certainly we do believe that risk assets, the path of least resistance, at least over the next couple of months, is higher. And then, or at least through mid-October, certainly by late October, I think the market will start to look forward into the net liquidity provision looking a little bit differently. But certainly over the next 6 to 8 weeks, we certainly think the path of least resistance is higher, particularly as the economy bounces off the Delta variant. I've been talking about that in my recent notes. We've seen PMIs and leading survey data all come in pretty sharply in August. And part of that was, the Delta variant. We're starting to see leading indicators, particularly if you look at South Korea's manufacturing and non-manufacturing business survey data. That's all started to bounce meaningfully into the month of September. They do their survey on a 1 month lead, and it tends to lead global PMIs and ISMs by exactly a month. And so we would expect that the impact of Delta is really going to start to wane and obviously, create some scope for additional upside and more importantly, market leadership by cyclicals, sectors and style factors, small caps, things of that nature. So again, that's kind of the life that we expect to live over the next 6 to 8 weeks. If that changes, we'll tell you. And obviously we just outlined the things that'll make us change our minds on that from a market signaling perspective. But for what it's worth, all three of those things, the dollar, the high yield OAS, and the VVIX ratio are currently in neutral VAMS state. So nothing to signal, nothing to worry about now. And then lastly, so as per our bullish expectations for risk assets, at least over the next 6 to 8 weeks, we are content to add incremental risk to our portfolio construction by buying high yield credit junk bonds, which just broke out to bullish from the perspective of our volatility adjusted momentum signal. On slide 4, so looking at our prior portfolio construction here, the one thing I will call out, and I got this wrong, and I'm correcting nothing from a position perspective, but I actually got what should have happened when we went to the hybrid deflation Goldilocks portfolio is that if you look at slide 5, we should have actually allocated 70-30 from the perspective of the 70-30 equities and commodities, fixed income, FX that the Goldilocks pie highlights. We actually allocated it all to equities, but now I'm actually moving that 12%. If you do the ratio math there, that 12% is perfectly what should have been allocated to fixed income and FX. So now when we're talking about adding risk, and with the context of Goldilocks, we want to be adding risk in the context of fixed income and FX. Obviously, as I mentioned, we've talked about this over in recent months, but when I look at the grid asset market backtest considerations, the reason I don't change it for our market regime views is because if the market regime changes, we still want to be left with exposures that are likely to survive the economic and policy headwinds or tailwinds, right? Like at the end of the day, we do believe that the market regime is always and perpetually, trying to price in what's changing at the margins in the economy from the perspective of growth, from the perspective of policy, and ultimately from the perspective of monetary and fiscal policy. So that's why we stick with the grid asset market backtest considerations that are, okay, we're in a deflation bottom-up macro regime. And when I say bottom-up macro regime, that's what the economy's doing. Growth and inflation are decelerating, but they're not decelerating very meaningfully, as denoted by the zero sigma backtest in column 2 and column 3. We obviously don't have any expectations for the policy rate. Again, we're on slide 6 here. We don't have any expectations for the policy rate, balance sheet. We expect it to start tightening in latter part of mid to late Q4. November is the earliest we'll see them taper. I still think it's a December event, just so they can start that and be done by the next December if they go to $10 billion a month. And then fiscal policy, obviously, we're going to be tightening fiscal policy for an extended period of time, and irrespective of what we see with respect to the past infrastructure or the budget resolution, it's still going to be less than what we spent in the last, fiscal year. So that's going to be tightening at the margin from a budget deficit perspective. And then lastly, most of the world, particularly starting in September and October, you're going to see most of the world in a bottom-up macro regime deflation as well. Again, growth and inflation slowing simultaneously. On slide 7, so looking at the deflation fixed income grid asset market back test, as I mentioned, we're adding high yield credit. High yield credit, it's towards the bottom right, but when you dump everything in the portfolio construction candidate slide, which is again winterizing the sample for the upper median of performance in terms of annualized expected returns, and then obviously looking at the signals that have the best risk reward. You see down there at the bottom right on the slide here on this chart, the bottom right of the right chart, HYG narrowly makes the cut in terms of being a portfolio construction candidate. So we're going to do that. We can add some other things like you look at EMLC, CMB, EMB. These are all things that would work in the context of the grid asset market back test, but that would also satisfy our desire to take on more risk in the context of our sanguine views on asset markets. But again, everything's overbought, so I don't want to be too cavalier about that, because I certainly think Friday was an extremely newsy type event where I think a lot of people bought and a lot of people chased. You could see some of that you could see some give back over the next couple of weeks. And then I would be looking to add, things like emerging market, local currency debt, convertible bonds, BDCs. Those are kinds of exposures you can add within fixed income to actually increase your risk and your covariance with something like S&P beta. On slide 8, looking at our posterior portfolio construction. So down there at the bottom, as I mentioned, properly allocating from an asset allocation standpoint, moving that 12% cash appropriately to fixed income and FX, and then buying junk bonds, J&K, and then the rest we got 8% cash to deploy. We still have 16% cash in deflation. As I mentioned last week when we had a Bitcoin, we have a lot of risk in the portfolio already. If you think about two high volatility exposures like Ethereum and Bitcoin. So we do want to have some cash because we don't need to be fully invested in the context of having as much risk on as we currently do. On slide 9, looking at the global macro risk matrix, as I mentioned, I always like to kind of highlight how the week ended, just so we can get a sense of what might change in the beginning of the next week, if to the extent it's a head fake. I do believe the VIX signal, the bullish VIX signal, and the neutral signal in the S&P 500 is a head fake. I don't have a strong opinion on the euro, the British pound here. I do believe the euro. I think they're likely going back to neutral. I don't believe that they're going to break out anytime soon, just in the context of the relative policy tightness that we're likely to observe sooner in the U.S. economy relative to both the ECB and the BOE. In slide 10, looking at the global macro risk matrix market regime signals, those are, we got 18 confirming asset market VAMS there for deflation, but again, it's very low level of signaling, total signals, right? You got 49 total confirming asset market VAMS. It's only in the 29th percentile of readings. Here's how I would expect this thing to play out if we're having this conversation 6 to 8 weeks from now. I expect the green line on the market regime probability chart, the dark green line, to recapture the modal outcome from that perspective. And then at some point it'll be quite high on the page, and the black line in the chart to the left, total confirming asset market VAMS will be much higher. Let's say in the low 70s, low to mid 70s. I certainly think the market can really kind of get you back up to a level of signaling, whatever the opposite of neutrality is, a level of signaling confirmation of Goldilocks over the next 6 to 8 weeks that we saw in terms of reflation, kind of in early to mid-May. And then that's probably going to be it. And then if you think about it from the lens of our CACRI cross asset correction risk indicator on slide 11, that's how you'll get back in the danger zone. You get a lot of people to chase Goldilocks over the next 6 to 8 weweeks because they weren't adequately positioned for it ahead of time. And they're going to start to really put a lot of risk on in the context of the net liquidity dynamics are going to be quite favorable, and you're going to see a bounce in economic. You're most likely to see a bounce in economic data in September, and that's going to get the sort of reopening people back on. You're going to get a lot of people back into the kiddie pool. You can get the reopening people back in the kiddie pool. You can get macro funds who like looking at net liquidity back into the kiddie pool. A lot of folks are going to put on more risk, just like we were trying to beat them to it. We have beaten them to it. Obviously, we're adequately positioned for what happened last week, just in terms of the moves we've been making in the portfolio construction over the last 6 weeks. And so, that's a golf clap for everybody on Team 42 for observing and orienting themselves with the process. But at the end of the day, I'm not here to try to get you guys to do what I'm doing. I'm here to help you, augment you, help you explore your thought process, your decision making. You're more than welcome to follow along, position by position, screw for screw. But that's not what we're trying to do here. We're trying to educate you and help you get to a place where you can think about managing macro risk at the highest level. These are the kind of conversations. What you're seeing in this slide deck, and obviously in our macro scouting report, 150 slides. These are all the information and data sets and math that I'm having conversations with guys at the biggest asset managers, with guys at the most well-known hedge funds, all across the world. It's the same conversations. I'm just democratizing that information to the best of my ability for Team 42. On slide 12, positioning, looking at that through the lens of the CFTC Commitment to Traders report. The only thing I call out is there's a slightly negative near-term warning signal for WTI crude oil. If you look at the month-on-month delta, we actually saw minus 83,000 contracts come out. That's a minus 2.1 1-year Z-score in terms of the delta on that time series. And then that's historically you've had minus 80 basis points on average of 1 month forward performance. I mean, that's hardly anything to write home about. So that's why I said slightly negative. On slide 13, looking at our crowding and dispersion analyses, with respect to crowding, there's still a ton of quote unquote rally fuel left in terms of like the meaningful I-vol premiums, looking at the relationship between 30-day at the money put implied vol relative to how we calculate the local realized volatility regime, which is just the average of 10-day, 20-day, and 30-day realized volatility. You're still seeing a decent amount of I-vol premium across the board. Even some crowding, if you look at like small caps, gold, high beta, healthcare, not a ton of crowding, but just decent crowding. But certainly, if you look at it for something like Qs, junk, mega cap, growth, tech, consumer staples, I mean, geez, that's been and actually that's something I want to call out. It's like you're seeing a lot of crowding, particularly in rate sensitivity. I think people expect this tapering discussion path towards tapering to be extremely hawkish, and ultimately, you still have a lot of people out there. It's like that keep saying bond yields are going to be at 2% by year end. I don't know that they're going to be 2% by year end, but I certainly do believe that we've probably seen the bottom, the lows in treasury yields. Now, that doesn't mean like you got to run out and sell everything, because again, the whole point of having a balanced portfolio construction is we don't know the outcome. Like we expect Goldilocks to dominate. We understand that we go with an inflation slowing, and we expect it to slow on a trending basis, going forward, with the exception of the September bounce in the data. These are all things where the models and the signals are telling us to expect, but the reality is, if you don't ever want to be too far over your ski tips in one regime or another, because that's how you get blown up when idiosyncratic risk happens, when the turn happens, and you see about 2.5 turns a year in terms of going from, one of the positive grid regimes to negative and back again. That tends to happen about a couple times, 2 to 3 times a year. So when those things happen, you don't ever want to be too far over your ski tips. You want to compound returns in a low volatility way and avoid drawdowns, and actually grow your nest egg and grow your capital, your hard-earned capital, in a low vol way, as opposed to, okay, I feel fantastic about reflation because I'm 150% long reflation on May 1st, and then I lose like half my money. That's not how you want to do this. That's exactly, so that's why we still have some balance in the portfolio construction. Just reminding people of that process. On slide, just looking at dispersion, the one thing I call out is that it's not clearly and obviously signaling one grid regime or another, and it probably means we're in a transition period from the perspective of sector and style factor leadership. So this is something we'll monitor closely in the coming weeks. On slide, skipping ahead to slide 15, kind of get into the wood chopping portion of all this. So the S&P 500, that's neutral VAMS, it's overbought again. The VIX breaks back down to bearish VAMS. The S&P won't be overbought because, again, the upper boundary of the probable range will be skewed to the upside. As I mentioned, for those of you who are new, the VAMS and the probable range processes are intricately linked. They're quantitatively linked. When you have a bullish VAMS signal, there's the probable range is skewed to the upside. When you have a bearish VAMS signal, the probable range is skewed to the downside. And part of the reason for that is that, one thing that I've noticed with a lot of sort of trading signals, or a lot of, just risk management levels in general, a lot of investors, they don't react to the change in volatility and what the change in volatility and price imply for the forward outlook for returns. Like the return distribution changes when the shape of the return distribution changes when these assets are in different VAMS states. And so you have to understand that you don't want to be, buying dips in something that's about to break down to bearish VAMS, because, the range hasn't reset itself yet. The slower moving ranges will reset themselves on a longer lag, and it causes you to buy dips too early for things that are starting to break down to bearish VAMS, or more importantly, they'll cause you to short sell things that are breaking out the bullish VAMS too soon, too early. And our process is specifically and expressly designed to help you avoid making those kinds of mistakes, because quite frankly, they're not very bright mistakes to make. And looking at WTI, spend a second here talking about WTI. bearish VAMS overbought. I don't think we can go to Goldilocks for 6 to 8 weeks with crude oil breaking down. Maybe it's a leading indicator for everything I said about Goldilocks being dead wrong. I certainly make no representations about that. It's always, 100% of what I say could be wrong. 0% of what I say could be wrong. It varies. Who knows? My whole point is we're going to wake up and flush the process every single time and see what the process says. This is the one thing that's kind of sticking out to me. That's like, I don't like this chart. I don't like the signal. It doesn't look great. Now, the one thing I will say is both the OVX and the price signal have prices broken out. OVX is broken down back to levels that if they stay, south of those signal lines, crude oil is going to break back to at least neutral. So we'll see. Again, it's obviously overbought by some near-term protection. We'll see how this looks over the next couple of weeks. On slide 16, looking at the US dollar, that's neutral VAMS. It's oversold. So again, dollar's oversold, crude oil's overbought. You could be expecting a reversal of a lot of what we saw last week, or you could see some, if these things are about to push lower and push higher in terms of dollar and crude oil respectively, that's something that's, that's how you can get at that transition moment. And so I expect it to be a transition moment where you can see a little bit more weakness in the dollar over the next couple of months and a little bit more strength, and certainly a lot more strength in crude oil over the next couple of months. But again, could be wrong on that, but we're observing, we're watching it. Looking at 10-year break even. So dollars oversold, break evens overbought. And by the way, the reason I look at, going back to slide 15, S&P 500 WTI, $16 and 10-year break even, then in 17, the nominal 10-year and high yield OAS, which by the way, nominal 10-year is bearish VAMS, it's nearly overbought. High yield OAS is neutral VAMS, it's certainly oversold, unless it breaks the bearish VAMS, which will catalyze a meaningful widening of the lower boundary of its probable range. The reason I look at those 6 indicators is I get asked all the time on client meetings, like, okay, you got your global macro risk matrix, 42 things. I'm glad that you're watching it, so I don't have to. But like, if you give me like one thing or like a few things to just monitor, which of those things do you think have the most impact? And I'm not necessarily saying that these have more impact than the others. What I'm saying is I think you can figure out what grid regime you are in very easily by observing those 6 signals. And so on slide 15, if the S&P 500 and WTI are bullish, you're above the chart, right? You're not going to have a bearish S&P, bearish WTI if you're above the horizontal line on the grid regime chart, i.e. you're going to be in Goldilocks or reflation if they're bullish. You're most likely going to be in deflation or inflation if they're bearish. On slide 16, the dollar, if it's bearish and 10-year break evens, if it's bullish, probably means you're on the right side of the chart, right? Your inflation's accelerating. Whereas if the dollar is bullish and break evens are falling, it probably means you're on the left side of the chart. Inflation's likely falling. And then lastly, on slide 17, just thinking about this through the lens of policy, if high yield OAS is going down and 10 years are going up, that means policy is responding appropriately to positive dynamics in the economy, like it's getting hawkish at the margin. That if you have a 10-year going down and high yield OAS going up, that means the policy setting is getting easier at the margins in response to a slowdown in the economy. So again, that's why I look at these 6. I flag these 6 ones, kind of every week and every macro scouting report specifically, just so I can kind of unpack a lot of those dynamics that help me, that help me explain to other investors, who aren't as deep in the weeds on the 42 different indicators in the market, or the hundreds, if not thousands, of indicators that we're looking at from a high frequency perspective to identify where the U.S. and global economies are from the perspective of their bottom-up macro regimes. On slide 18, looking at the high beta, low beta ratio, that's bearish VAMS for now. We'll see. I don't think it's going to stay bearish VAMS if we go to Goldilocks. Small cap, mega cap ratio, that's bearish VAMS for now. Again, these things are bearish VAMS and overbought, so probably means we could see a little bit of a pullback on a relative basis in things like small caps and high beta. But again, I don't think it's a time to short sell those exposures in absolute terms, because again, I do believe you could see some unconsolidation that's positive for high beta, positive for small caps, positive for cyclicals over the next couple of weeks, next 6 to 8 weeks. On slide 19, value growth ratio, that's bearish VAMS, it's oversold. So again, these are the kinds of things they're telling you, like, hey, the market has not fully positioned for a return to cyclicality. So we've seen all these violent rotations all year, in terms of, going from, pro-reflation to pro-growth, to pro-growth, to pro-reflation. It's been pretty violent, particularly starting in February of this year. And the reality is, and we've actually, quite frankly, we've had violent rotations going all the way back to the beginning of last year. We went to super deflation, super defense, and then we came out in cyclicality, And then we went back to super defense in the summertime. And then, it was like a transition period from September through the end of October. And then boom, it was massive cyclicality. And then, that cyclicality really accelerated to the upside in, January and February and March. And then ultimately that, kind of gave way to, some of the bottoming of process that we saw in the defensives in early to mid-May that obviously have really gotten us to this point. That's why value to growth ratios is bearish. That's why high beta to low beta ratio is bearish. That's why small cap mega cap ratio is bearish. So let's see if we can. I would expect a lot of what let those bearish signals to the bare minimum go back to neutral in the next couple of months, 6 to 8 weeks. I think is the kind of the target time frame for Goldilocks. I'm not trying to be specific, kind of to put a Tiffany bow on this whole discussion. I'm just trying to give you sort of my expectations. For those of you who are playing with the options and you thinking about the calendar, thinking about strikes, like to me that I'm giving you my expectations with the understanding that, hey, look, if it changes, it changes. If it goes from 6 to 8 weeks to 12 to 15 weeks, and I'll tell you when we're at the 8 week mark. But if it goes from 6 to 8 weeks to 2 to 4 weeks, I'll tell you at the 2 to 4 week mark. That's the whole point of waking up and doing this every day, is because again, we don't know. I wake up every day assuming no knowledge of the prior state. Refresh all the models, refresh all the signals, and we get back to the same. We build up the process every single day. Every single day, we're adding all this data and we get to a place where it's saying do X, Y, Z. And that's all we're really trying to do. If we try to do a little bit more than that, then I think it's going to be thesis drift, process drift. What we're trying to do is sequence macro. I think a lot of people do destination macro, and don't get me wrong, there's nothing wrong with destination macro, but the sequence is how you make or lose money. Like you can't do destination macro on the buy side. You literally lose your chair in weeks. You have to do the sequence. The sequence is how you make or lose money. The sequence is how you make or lose money. Never forget that statement. But lastly, here on slide 19, the VIX ratio, that's neutral VAMS, not actionable. Not that you can look at the VIX ratio anyway. But anyway, getting into the portfolio construction, defense, DEF, that's bullish VAMS, not actionable. Same with mega cap growth. Slide 21, size, both size and real estate are bullish VAMS, not actionable from the perspective of their probable ranges. Slide 22, healthcare, neutral VAMS, oversold, great buying opportunity there. Ireland, bullish VAMS, not actionable. Slide 23, Ethereum, both the digital asset and the ETF are bullish VAMS, not actionable. Same thing with Bitcoin on slide 24, both the digital asset and the ETF are bullish VAMS, not actionable. Slide 25, looking at the Eurozone, that's bullish VAMS, not actionable. WTI crude oil, that's bearish VAMS, it's overbought. Please buy some protection in crude oil this week. Dollars oversold, crude oil is overbought. Again, I want to keep this on because I don't believe we're headed for a real meaningful lasting breakdown in crude oil. I think the red bar that we're currently observing in the top half of that chart is going to be a narrow red bar, and we can bare minimum break back to a gray bar, potentially by the end of this Goldilocks period, back to a green bar. But again, today the quantitative setup is disgusting. So please buy some protection in that, just so your near-term protection, just so we can kind of get through the next couple of weeks and see how we shake out in terms of the rest of the world participating in Goldilocks or maybe even disconfirming it. On slide 26, materials, bullish VAMS, not actionable. Same thing with financials. Slide 27, Barclays Ag, AGG, and EDV, bullish VAMS, not actionable, both of them. Slide 28, looking at EM dollar debt and 5 to 10-year tips. Same thing, bullish VAMS, not actionable for both. Slide 29, TLT, bullish VAMS, not actionable. The US dollar, neutral VAMS, that's oversold. So buy short-term upside protection there, or short-term downside protection in something like crude oil. And then lastly on slide 30, high yield credit junk, that's breaking out to bullish VAMS. It's nearly overbought. So when you add these new positions that are nearly overbought, you want a dollar cost average. That's what DCA stands for in that parentheses. And then kind of getting a secondary check on high yield credit. We obviously look at high yield credit spreads every day, but even looking at the more risky part of the high yield market, because again, you can make the case that the high yield has become increasingly bifurcated. Half the market is a duration play. The other half of the market is a credit play. It's increasingly as rates go lower and lower and lower at every successive cycle, more and more pockets of high yield become, basically, IG for lack of a better, they become effectively IG in the context of investors reaching for yield and being willing to assign lower and lower rates to certain types of businesses and industries. But the reality is, kind of looking at the most risky and cyclical part of high yield, looking through the lens of triple C, OAS, that's neutral VAMS. So you're getting a double check there in terms of not being bullish VAMs. You don't want to see the worst. Liquidity dries up at the fringes. That's one of my sayings, my investing sayings, and I think it's a really important one. When you're about to have a problem, the liquidity goes from triple C's and Ireland and Bitcoin and Ethereum before it goes from Apple and Google and Facebook. Like it's you're going to sell Polish bonds before you sell the U.S. Treasury. That's what I mean when I say liquidity dries up at the fringes. You typically see when you're heading into a meaningful market event, positioning gets extremely stretched, particularly at the fringes, because people are reaching for yield and reaching for return in places like that because they're not getting yield and return in the more sort of crowded parts of the market. And that's why you tend to see when things reverse, it reverses at the fringes sooner than it does towards the core. So we're getting a good signal from the fringes that, hey, we can take some more risk. Junk bonds breaking out the bullish from the perspective of our VAM signal. So with that, this is Darius Dale, your skipper here, presenting our Around the Horn Weekly for Saturday, August 28th. Let's go out here and make some money. Cheers.